Last time we talked about how Steve managed to miss out on the stock market rally. I'm waiting for the market to bottom out. The moment the market goes down again, I'm going to buy. Now Steve wants to invest into the market and he wants to know how to make a diversified and balanced portfolio. In this video, we are going to talk about the basics of a financial portfolio and how you can build your own. Make sure you read our disclaimers in the description and at the end of the video. I am John V, founder and CEO of Agent Risk Wealth Management, and if you haven't subscribed already, literally I have no idea why you haven't, click that red big button down there, okay? Let's do it. For this portfolio, for this small experiment, we're going to use ETFs. The same principles apply when we're trying to use mutual funds and stocks. We talk about tips and tricks for mutual funds and ETFs in another video, so don't forget to subscribe. This is our playground. We have our stock market data here. Our portfolio. And the results, how much money we made or lost. I'm going to build a very simple portfolio only with SPY, an ETF that represents the S&P 500. I then select 2008 as the year I first invested in. Let's see what happens. If I had invested $10,000 in 2008, I would have made that much money today, and the worst performance I would ever have is that. Let's try a different year. Let's try BND. BND represents the total US bond market. The performance characteristics are different. BND made more money than SPY for an investment that took place in 2019 until now. This is due to the fact that BND had much less maximum drawdown, 1.43 versus almost 20% of SPY in a year. That means that BND was a little bit more stable than SPY. Let's try 2008. We see the difference in performance. Why that performance is different though? SPY and BND are two ETFs that represent different segments of the market. SPY tracks equities and BND tracks bonds. Historically, equities are riskier as we saw, and bonds, and fixed income securities in general, are less risky. The logic behind it is that when the economy feels shaky, people trust bonds more, and when the economy goes well, they prefer equities. Having both equities and bonds in your portfolio balances it out, as when the one goes down, the other goes up and vice versa. Let's try to mix up our portfolios. We'll create a portfolio with 80% SPY and 20% BND. A portfolio with 60% SPY and 40% BND might be a good portfolio for people that are planning to withdraw money soon enough, as it seems that it doesn't have such big lows. It feels safer. As we can see, by adding more assets and by playing around with the percentages, with the allocation, We generate different results. We change the characteristics of the portfolio. How do we know which assets to use and which percentages? This is the first step of building a diversified portfolio with low-cost ETFs. But the stock market has so many stocks, so many mutual funds, so many ETFs. How do we know which one we should choose? And I want to add as many as I can. I want to try out GLD, XLE, VUG, VNQ, or I don't know, TSLA, or whatever you like, whatever is your favorite. I want to build portfolios with many different ETFs, mutual funds and stocks and see how they behave. But not today. Leave a comment below and let me know which other ETFs, stocks or mutual funds you want to see us playing around with. Until then, see you next time.